Good afternoon, fellow traders. Thank you for attending today's webinar about proper money management in FX. Today we will touch base about how to manage your money. What are the things that you definitely need to keep your mind on, and what you definitely should not ignore when it comes to money management in trading. Okay, so before we continue any further, just please write in the question section whether you can properly hear me and can see the presentation. Perfect. Thanks all for the confirmation. So while the last few people are connecting to this webinar, let me just quickly go through the disclaimer so we get this out of the way. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent of those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, give me just 10 seconds and I will continue. Thank you. Okay, so a bit of water as a fuel for this webinar. Let's get this started. So at first, of course, we will go ahead and I will quickly introduce myself. Then we'll talk about the two market types you will come across when trading. We'll discuss account sizing, how to set your risk levels, and of course, last but not least, we'll talk about currency trading dangers. And this is something we discuss on every webinar just because this is really important, okay? And of course, at the end, you can also ask your questions. So please, during the webinar, if you get any questions popping up in your mind, just write them down on a piece of paper or inside a notepad, and then just shoot what you have at the very end, when the right time. Okay. So I am one of the senior traders in Blue Sky Forex. We are an educational research and trading group. We do provide 24-hour trade support analysis just to allow FX traders to trade safer and make better and more profitable trading decisions. There's a bit less than 10 members in our team at the moment, and Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So, two market types. The first one, as you know, is price action, aka trending market, and this is definitely more powerful. You have heard the expression trend is your friend, which I totally agree to. Identifying a proper trending market with the proper price movements that you can realistically benefit from is a bit more difficult than identifying a mean reversion market. And this is due to proper trending market. It needs to be fueled by significant economic news. Okay, it needs to be backed up by news. So if you don't know what characteristics different news have, what impact different news have, then it's simply best to stay out when news has hit the market, whether the price is really significantly trending or not. So I would highly recommend just to get a basic knowledge of what news events have the most impact, like the non-farm payrolls, in example. These usually carry relatively significant weight. Of course, depending what currency it is affecting, what country the news is coming from, etc. So just gain a basic knowledge of the news, and you will be able to identify more easily if this certain significant trending move that you are observing is caused by the news or something else, whether it carries significant weight and it is tradable or not. Okay, and the next market type is mean reversion, aka ranging market. It is easier to identify. It certainly can be profitable, depending on what strategy you use, what approach to trading you use when you are trading, aka what session you're trading in. Now, no matter what market type you are trading in at the moment, you will still need to be able to manage your money and manage your emotions and manage your risk. The last webinar was about managing your emotions, really important topic as well. So please pick up the webinar's recording at the past webinar section on hot Forex. Highly recommend. So anyways, you do need to be able to manage yourself in overall, okay? So let's discuss how you should be sizing your account size, okay? Now, there are two things you need to keep in mind that are really important, that are really basic and really straightforward. But having too large account size is not really optimal. And having a too little account size is not optimal either. And I will explain a bit in more detail. Now, if you have an account size, let's say $1,000, okay? Now, if you lose $100 of your account balance, percentage-wise, you have lost completely 10% of your total account balance, okay? So this 10% is a very large, it's a large percent, right? If you had an account size of $10,000 and you lost $100, then you would lose only 1% of your total account equity. Okay, so this knowledge of how much you have lost with that, percentage-wise, with that $100 loss, this has a great impact on your emotions, your approach to further trade decisions made on that same trading sessions or even few next trading sessions, because you will think that you have already lost 10% of your account equity. Okay. If you have a $100,000 account, which is quite a large account size, then you might end up just losing the respect towards your capital. Okay, you will always see that, hey, you have a 6-digit as your account size, losing $1,000 here, $5,000 there, doesn't really affect your account size that much. Certainly at first, we might not have such an effect, but if your losses, accumulate, then it will anyways lead to account ruin eventually, right? It's just that at the very first, you will simply not realize that you are doing something wrong because the loss essentially is not so significant for you to adequately notice that your account balance is decreasing consistently, okay? So those two things are really important to keep in mind, and you will need to find this balance between under-financing your account and over-financing your account, okay? So always think about that. Now, how to find a good balance between just, financing your account and making sure the balance is not too little or not too large, is you can simply calculate your net asset value, NAV, just excluding the depth zone, of course. And then size your account balance not to be higher than 20% of your net asset value. Okay. So let's say you have a total net asset value of $100,000. You know, your car, your whatever assets that you have. Maybe you just have a rental apartment. You can't, put that into your net asset value. All these things accumulated. Your balance that the investment that you make towards trading should not exceed 20,000. Okay. So that is definitely something to keep in mind. 20% is even the very extreme maximum, I would say. It's best to maybe keep it around 5%, maybe 10 if you have a very large risk appetite, so to say. But yeah, 5% is, I think it's more than enough to get started. Okay. So in this scenario, your initial investment would be $5,000, and this is relatively sufficient just to get started, just to earn a bit of profit on top of your balance. And however, I wouldn't say that this is enough to actually make trading as your first occupation, just to live off trading. First of all, you need to practice. You need to know that you are able to consistently increase your account capital, your account balance. You're consistently able to earn profit, and only then, start considering making trading your main source of income. Okay, you just have to start small. You have to take it step by step, develop your trading skills and strategy, and eventually take the leap of faith and rely on your skills and take up trading as your first source of income, if you may. Okay. I think we already went over everything that is on this slide. Now, determining the risk levels that you apply when you are making your trade decisions. Okay. There are 5 things to take into account. First and foremost is a leverage. We'll get into leverage a bit more detail on the next few slides. The next thing is risk-reward ratio per trade, and of course this translates into risk-reward ratio per trading session. Then of course max percentage of account exposure. We'll talk about correlation risk, a really important thing to keep in mind. One of the very first basic things that I learned when I got into trading. I made a lot of mistakes with just trading correlated pairs because they showed similar attributes at that time of the market, but eventually it worked out really bad for me. And event risk, which is essentially news and whatnot you have released on the news sessions. Okay, leverage. If you don't know what leverage is, I do highly recommend looking up some reliable sources like Investopedia, for example, just to get a very detailed, very professional, and very accurate explanation what leverage is, and just reading through it really thoroughly. But just to put it really bluntly, okay, somebody can't see the slides. There is always somebody whose webinar module is not operational properly. Usually pausing the screen sharing and sharing it again should fix the problem. If it doesn't, I do apologize. You should check the recording of the webinar later on from the past webinar section. If it worked, then great, and then let's continue. So leverage is, putting it really bluntly, leverage essentially determines how much money you have to borrow from the broker every time you make a trade. Okay. Now the best traders, and obviously the traders who practice the most safest trading methods, they use either no leverage at all or the complete minimal leverage possible. Okay, either 1-to-1, which is essentially no leverage, or 5-to-1. Anything above that becomes quite risky, which you should avoid if possible. Just giving you an example, if you have a $100,000 account, okay, and you are trading without any leverage, you're trading without margin, you cannot receive a margin call. If you don't know what a margin call is, then please, again, look it up on the web just for a very detailed and very professional explanation about it. This is something that is better if you take your time, look into this, and understand it yourself. Okay, that is at least how I feel. Anyways, if you open up a position with that account capital, $100,000 position, let's say on USD JPY, and the move on the USD goes up by 1% against the yen, and then the gain on your account is $1,000, essentially 1% of your total account capital. Okay, if you were trading with leverage, then the rise would be higher percentage-wise, a higher percentage move on your account. Okay, so thus you can essentially with lower amount of capital earn the same amounts of profits like with a larger account and no leverage. Now this works both ways, and this is why this is it is dangerous to use a larger leverage. Okay, because while you would be able to earn more with higher leverage, you will also be able to lose more and a lot faster. Okay, so this is why it is safest to trade without any leverage. If that is not possible and your account size is really low and you want to provide yourself with an option to at least earn some money, then theoretically you are forced to use some leverage. But if that's the case, then please keep the leverage as low as possible. Okay, and as I mentioned, best traders, they use no leverage or minimum leverage like 5-to-1. All right, now risk reward ratio or reward risk ratio, doesn't matter what way you say it. The way you say it then just depends the order of the numbers. Okay, so let's talk about, as you see on the slide as well, we're talking about reward risk ratios. Okay, and you see the ratio of 2-to-1. This reward risk ratio means that your potential gains are 2 times the amount of your potential losses. Okay, and then in practice, this translates into your take profit levels being 2 times the distance of your stop loss. So let's say your take profit is 100 pips away from your entry. That makes your stop loss being 50 pips away from your trade entry. Okay, really easy, really straightforward. It is wise to, when you are starting out, when you're testing a strategy and just trying to find yourself, what kind of trader you are, just gaining knowledge, gathering or trading yourself and your trading strategy, then it's best to use a reward risk ratio of 1-to-1. Okay, that means your take profit is the same distance with your stop loss. If you get better over time, it's wise to increase your reward risk ratio. 2-to-1 is a very decent reward risk ratio. If you are already experienced trader, then you can use this reward risk ratio, even if you are testing out few experimental strategies, an example, because you will know already how to manage your emotions and money better. Okay. Over time, if you become an expert trader, having reward risk ratio of 3-to-1, 4-to-1, or even 5-to-1 makes complete sense. So on the other hand, I would really like to stress the fact that it's unreasonable to set a non-realistic reward risk ratio like 10-to-1, because in this scenario you will most likely never be able to hit your take profit levels, and before these levels are hit, the price will most likely reverse and hit your stop loss levels instead. Okay. If you have managed your stop loss actively on your trade, or if you have used a trailing stop, then that's fine, because you will still be able to lock in some gains. Although if you are a shorter term trader and if you are scalping the markets, then most likely you will be not using a trailing stop. And as per my own recommendation or suggestion, if you are a short-term trader, then you should set your reward risk ratio when you enter the trade and stop messing around with the take profit and stop loss levels after you have entered the trade. Okay. In this scenario, you will certainly hit your stop loss levels before your take profit level. So don't overdo it. Don't set unrealistic reward risk ratios, because you will lose money instead of winning more. Okay. Excuse me. Right, I think we discussed everything on this slide. So let's continue with max percentage exposure per trade. Okay. So a rule that we are following here in our team is that each and every single trade is around 1% over the total account equity. Okay, so 1% is completely fine. Another thing is, if you are a bit more experienced trader, you can apply the Kelly risk management formula that you see on the red text below. It does incorporate the historical success rate, profit factor, just to determine the risk level. And if you do lose more than 5% of your total account equity per trading session, then you should stop and walk away. Okay, because going for any further than 5%, you risk yourself going into the revenge trading mode, and you won't turn back the capital that you have lost that far. So just to prevent you yourself from doing that without knowledge even, then you should set the really strict rules to your own trading. Okay, this is really paramount, that you do not break the rules that you set. Okay, the rules that you set for your trading, they are part of your own designed and developed trading strategy. By the way, the next webinar that we're going to have is specifically about a trading strategy, not the trading strategy that actually vice versa. It's not about a trading strategy, a certain trading strategy that you will find online based on some indicators, but the trading strategy. And what I mean by that, we're talking about your trading strategy that you apply to your own trading. Okay, we'll talk about what the strategy consists of, and perhaps a few suggestions how to develop one and what to keep in mind. And setting these rules and these limits to yourself is part of the trading strategy that you will need to develop. Okay. So don't risk more than 1% of your total account equity per single trade. And if you have already lost 5% of your total account balance, then stop trading. If based on the Kelly formula, you will receive a higher percentage, then we still recommend to keep it at maximum 5. Okay. So correlation and event risk. And by correlation, we mean the currency correlation between each other. For example, Euro USD and USD UCH. Okay, these are highly correlated pairs. They're essentially mirror images from each other. If you put them next to each other on the chart, you will see extremely similar movements, but in the other direction. Okay. So Euro USD and USD Swiss franc. These are, for example, one of the most correlated pairs I think ever. Okay. You will definitely see some similar movements occasionally between Euro USD and cable, aka GBP USD. However, generally the majors are considered quite and relatively uncorrelated pairs. The correlation happens more between exotic pairs, cross pairs, and majors, in example. It is really important to, at some point during your trading activities, to open up the correlation chart. There are different providers. There are a lot of different correlation charts available on the web in different layouts that provide you the same information in just different visual and graphical ways. You should find the one that suits your eyes the best, that is the easiest to read for yourself, and find out what are the most correlated pairs. If you are used to trading certain assets, then just check if there is any significant correlation between those pairs that you usually trade, and try to refrain from trading those pairs at the same time. Okay, because if you trade correlated pairs at the same time, a simple spike on one pair can translate into a spike on another pair, and you're just exposing yourself to double the risk. Okay, if you're long on Euro USD and you're short on USD Swiss franc, then you're essentially you have two really similar trades open, and an upward spike in Euro USD can result in a downward spike on the USD Swiss franc, and both of your trades will have the same result. Of course, if it all goes well, you have won twice the profits, approximately, and really bluntly saying, but you're still exposing yourself to double the risk. We always recommend to keep the risk as low as possible, just for you to have the safest experience when trading. Okay. So looking on Google, correlation heat map is a good keyword, and then you will find a lot of different correlation charts. Please use them even during your trading session, just to check actively what pairs can be correlated and what not. Okay. And in regards to the event risk, this is something I mentioned earlier on the webinar as well, that if you are relatively unfamiliar to trading during the news, or if you are just starting out and if you haven't yet found yourself, what type of trader you are, and haven't really found your own strategy yet, then it is recommended just to keep out from trading during the news. Okay, significant news can create short-term, really hectical and volatile movements on certain assets. And it's really easy to have your trade ending up in a loss just because of one simple spike that lasted for 10 seconds before going in your desired direction, right? So the prices can become really volatile, really unexpected moves occurring. So it is wise to give it around maybe 15-20 minutes to let the price settle in. Let all these unsettled buy and sell orders be initiated, and for the market and the price to decide in what direction it's going. Okay, just let the bulls and the bears have their fight. Whoever wins, you'll know where to trade. Okay, that requires indeed some practice. It requires some fundamental knowledge and understanding what are the news affecting the market the most. So definitely worthwhile tapping into the fundamental part of trading if you want to be successful longer term. I'm personally really technical. I'm a really technical trader. I do love my indicators, although if I want to be successful, and I know it myself, I do have to be well versed with the fundamental part as well. I have to understand the news. I have to be prepared to always monitor the economic calendar and see what are the news hitting during my trading session, and what assets to avoid, perhaps when to avoid trading because of most likely extreme volatile movements, etc. Okay, now let's talk about adding to positions when in loss, aka martingaling. Okay, martingaling is extremely dangerous. If you don't know what martingaling is, I would recommend look it up on sites that do provide education and information about all these um, keywords related to trading. Essentially, martingale is doubling up your position on the same asset and in the same direction consecutively. Okay, you're increasing your trade size with each consecutive trade, hoping that the newest trade will earn back some of the losses created by the very first trade if the price will at one point turn and go in your desired direction. Okay, this was just to put it really bluntly and straightforward, but with few examples and more sort of say scientific explanation, you will definitely be able to find on the web. It might take a bit of time to get your head around. Okay, an alternative to martingaling that we also sometimes use here in certain scenarios is dollar cost averaging. It has few similar attributes to martingaling. However, there are some significant differences that makes dollar cost averaging not so risky as martingaling. Okay, so let me explain. If your usual standard lot size that you usually trade with, it's, let's say, one, okay, one lot size is something you usually use. Now, when you apply dollar cost averaging, the very initial trade that you initiate will have a lot size of 0.3. Okay, let's say that the price moved against your desired or predicted direction. You will initiate a new trade on the same asset in the same direction, and again with a lot size of 0.3. Now then you have two trades open on the same asset in the same direction, but the second trade is with a better entry price. Okay, and if the price again moves against your desired direction, you will initiate a third trade with a lot size of 0.4. on the same asset, same direction. So now you have 3 trades open at the same time on the same asset and in the same direction, but all the lot sizes of those 3 trades equal to 1, like your usual standard lot size would have been. But now each consecutive new trade you have on the same asset will have a better price. So you're averaging out your entry price essentially. And if at one point your at one point the trade does reverse and go in your desired direction, then you have earned a bit higher profits because the third trade had better entry price than the first 2. Okay, and if you have set a fixed stop loss, let's say after 50 pips, and based on your very first trade entry, then you would have also lost a bit less funds because your third and second trade entry was closer to your stop loss. Okay, I hope that made sense. It is quite straightforward. Now, some things to keep in mind that you should only apply dollar cost averaging when your initial trade accuracy is around 50% or 55% maximum. If you have the initial trade accuracy higher than 55, maybe around 60 or more percent, then dollar cost averaging will not really work out for you that well because longer term you will have earned less profits. Okay, because if you are really accurate with your trade entries and make the right decisions, then with each and every trade you make, your initial trade size would have been 0.3 instead of 1. Okay, so you would have earned less profits with each trade. All right, so keep that in mind. Okay, last but not least, currency trading dangers. Now, something I really want to stress here is try to avoid trading with bots or expert advisors, or at least trusting them from the get-go, because most of them, they are designed to lower your account balance. They are designed to empty your account. So you have to be extremely careful. You will see on the web they are advertised that, set this up with a few clicks and become rich like within a few months. Hey, this bot is earning $500 per day profit for you. Really easy. Join up now for free. Test this out, etc. You get the point, right? All of these bots and robots and expert advisors, they are designed to empty your account balance. If you want to test out a bot or an expert advisor, please be so kind to use it on a demo account for at least 4, 5, 6 months. And if it has been able to consistently earn profits and raise your account capital without a significant drawdown, only then consider setting it up on a live account. And before doing that, you have to additionally do a really significant background check. Ask from another user who has been using the same system, what is their experience, how long they have been using it, how much money they actually have made, if possible. And use extremely low lot sizes with the bot. Okay. If it indeed is profitable consistently and longer term, then only then consider maybe raising the lot size per trade. Okay, a lot of these bots that do show a successful track record as well, they are built on martingale or they have built on grid systems. And a lot of these, just longer term, they won't work, because at one point there will be a market condition when the price keeps on trending in a certain direction extensively, maybe a few weeks, few months on a larger scale. So these bots will fail at those times, and before you notice, your account balance is 0. Okay, So please be extremely careful. Now, the next thing is, it is sad, but it is true that only 5% of the retail traders make money in FX longer term. And a really, really significant thing that attributes to this, so to say, high percent of failure is because we are all human. We have this extremely great thing we call the brain, and the brain has these extremely cool things called hormones and different chemicals that it does release when we are experiencing certain situations and emotions. Okay, if you are in a winning spree, you are winning trade after trade, um, then your brain will release a certain chemical that will make you feel invincible. You will receive adrenaline. Um, you will feel that there is no trade that can go wrong, right? So you are just shooting like from an automated machine gun, just getting those trades out there, just earning profits. But eventually what happens is your brain becomes a chemical mess and you are unable to analyze your trade decisions adequately, and you start making mistakes. You will lose some trades. You are in denial that, how can I lose these trades, but I'm on a winning streak, etc. And this can eventually end up with you losing your profits, maybe even lowering your account size, and then it turns you into revenge trading mode, because there is another chemical released in your brain, and in overall you are a trading animal. You don't think anymore and you make more of these stupid mistakes and you keep on blowing up your account. Okay, and this is something really hard and difficult to overcome. We don't have the control over the chemicals that our brain releases. However, we are in control of the standard trading practices that we create for ourselves. We are in control of the rules that we can set to our own trading, just to prevent us from overtrading and revenge trading. Okay, so it is really important to set rules. Please do set the rules. Um, Incorporate these rules into your trading strategy and be extremely strict with following those rules. Otherwise, there is really no point. And if you cannot follow those rules, then you might as well be better off not trading. Okay, because there's really no point to start gambling on the markets just hoping that, hey, maybe someday I'll win a million, right? That's not going to happen. The market will get the best of you before you will be able to make significant profit and walk away as a millionaire. Okay, let's face the reality. This will not happen. Okay, uh, and when it comes to losing money, just emptying one or two accounts, as I have mentioned before many times, it's not essentially a bad thing, because trust me on that one, most, if not all, professional traders have done the same thing. We have been there. Okay, we have emptied one or two accounts. Now, the 5% of the successful traders, what they have done in this scenario after emptying their trading account is analyzing themselves, what they have done wrong. Okay, because if you analyze what you have done wrong, you will be able to improve yourself. Okay, you will be able to prevent you from doing the same mistake again. You will be able to prevent, or you will be able to change a part of your strategy that might have led to the account ruin. So if you blow up an account or two, don't feel down. Try to analyze the everything that you have done this far, analyze your trading strategy, analyze your trading habits, the session you're trading in, etc., and change a part of it. Change the weak link, improve your strategy. Okay, and this is what makes you eventually a successful trader. You need to analyze your mistakes and improve and change. If you give up, like 95% of the retail traders, then you will be one of those 95%. You will not be successful, you have failed, and you will most likely never look back. Okay, so definitely keep that in mind. You need to improve. You need to be able to consistently analyze what you are doing on the market. Maybe even if you take a half an hour or even 10 minutes after your trading session. Okay, let's say that you have set a 4-hour trading session for yourself. You trade from 4 to 8 in the evening. Then after 8, you say to yourself that fine, I'll stop trading completely, but you will take 10 minutes to analyze what you have done during that trading session. Okay, how many trades you have initiated, what pairs you traded at, were there any news affecting those pairs, why were those trades successful or unsuccessful that you have made, and what you could have done differently if those trades were unsuccessful. Okay, just take 10 minutes after your trading session to analyze yourself, analyze what you have done, and it's better if you write all that down just to keep a record, keep a journal of what you have done during a trading session. And maybe once per month you take a few hours just to analyze the documentation that you have recorded. See if you find any patterns to your own trading habits. If you find a certain pattern after which your account balance has decreased, then you can work on it. Okay, you can work on changing that to do something else, right? Replace some element in your trading habit to something else. This is how analyzing yourself and keeping a record and keeping a trading journal goes. You just have to be really, really consistent. Don't skip this. Don't skip analyzing one single session, because otherwise you will, the next time it comes to that point that you should analyze yourself, but you think to yourself that, hey, I skipped one time, it doesn't really matter if I skip this time as well. I'll definitely analyze this next time when I get the time. No, this will not work. You have to be consistent, otherwise there is no point. Okay, and the very last thing, it's similar to the trading bots, that please don't trust the signal services and signal rooms. Only very few of them are actually legitimate. If you want to test one of these out, do so on demo account. Sorry, my microphone turned off. Okay, test them out on a demo account at first. If they are consistently profitable, if they do provide you with consistently profitable signals, then only then use them on a live account. Again, start with low lot sizes. Ask for an audit trail and a performance record before even considering to trade based on those provided signals. And do your research. Please do a proper background check, because none of us wants to see you empty your account because somebody else told you to take these and these trades. Okay, this is just plain stupid. Let's be honest here. Okay, it's the same if you see a stranger on the street, you hand them $100 and say, after 1 hour, let's meet back here, and you give me $110 back. Okay, you'll know that this will not happen. You will never see your $100 again. Okay. Anyways, this is the end of this material today. Let me just open the question section now, and I'll do my best to pick these up, answer to them. If any of these remain unanswered, then I do apologize. However, you can send an email to webinars@hotforex.com, and they'll be more than happy to answer to anything that remained unclear. Okay, Bruce is asking, how will the new ESMA regulations affect retail traders? This is an extremely good question. To my knowledge, they have completely banned binary options, for example, in Europe, and there are some changes that brokers are doing in terms of the leverage that they are offering. And everything related to risk management, because ESMA wants all the traders to be as safe as they can when they are trading. So brokers are forced to abide to some regulations and rules. Essentially, you should not experience an extreme significant change, but there might be some change in terms of the risk management boundaries, or the boundaries to the extent that you can use or utilize your account. For more information, I would highly recommend to check directly with Hot Forex legal team. What actions are they taking to make sure they comply to the regulations and rules. Olatsun Basun is asking, what do you mean by 5 make money in FX in longer term? What do you mean longer term? As per what duration? If I talk longer term, then I mean anything, starting from maybe 4, 5, 6 months onwards. Okay. If you want to be a successful trader, if you are, okay, let's put it like this. If you make money, when you engage the market, if you start trading and if you make money, if you consistently increase your account balance the next 3 months, okay, I will tell you bluntly and honestly, you can't consider yourself as a successful trader, okay? 3 months is not enough to consider yourself being a successful trader. Because 3 months, the market can remain in a certain condition that is really, really favorable for your certain trading approach and strategy. And after those 3 months, anything can change. And if you are unable to adapt to the new market conditions, if you are unable to adjust your strategy to meet the new market conditions, then you're not a successful trader. If you want to be a successful trader, it takes more than 3 months. It takes more than half a year. Okay? You will need to be able to adjust to the ever-changing market conditions and be consistently profitable if you want to consider yourself a successful trader. We're talking about being a successful trader, just being able to consistently earn profits. Okay, the profits can range from anything from even $1 per month up to several $100,000 per month. Okay, if you're making profit consistently, you are a successful trader. Being a professional trader, however, is also a different thing. Being a professional trader means that you can adequately benefit from all different kinds of market situations. You are able to benefit from the released news. You're able to benefit from ranging market conditions. Whatever is going on the market, you're able to adjust your trading approach to it, and you will be able to uh, earn consistent profits over a longer term and actually live off the earned profits from trading solely. Okay, then you are a professional trader. Okay, I see a question. What is the best recommended leverage size for a newbie? One thing I want to mention that I am not an investment advisor. I cannot provide you with this kind of recommendation. This is completely up to you what risk level you want to set for yourself. But in general, I would say it would be reasonable to anyways keep the leverage size as minimum as possible. For the least risk, you should go for 1-to-1. If that's not really an option, then 5-to-1, maybe 10-to-1. But anything over that already is relatively risky. So you should try to refrain from trading with extreme high leverage. Okay, Olatunbosun, sorry if I pronounced your name incorrectly, but he is asking, in the event of news on a certain currency pair on a particular week, a severe news in this case, um, should we take out profit before the news or leave the trade running? Um, leave the trade, 1 second. Or leave or exit the trade even if the trade is not in profit. Okay, so essentially, is it wise to exit the trade before the news, no matter if it is in profit or if it is not in profit? It's a fair question. What I would suggest in this case is rely on your own personal experience. Now, this, of course, depends on whether you do have some fundamental knowledge about an upcoming event or not. If, based on your knowledge, you determine that a certain event that is upcoming will most likely not affect the pair or the asset that you are trading, then you can leave the trade running. And of course, in this case, you'll be hoping for the best, right? If you want to be safe and make sure that in not under any circumstances your trade will result in further losses or higher losses due to the news event, then you can simply exit the trade and just be done with it, forget about the situation, and move on and look for additional trading opportunities. Okay, now again, this completely depends on your own personal experience and your risk appetite. If you are a beginner, I would highly recommend anyways trying to avoid the news as much as possible. If you want to trade longer term, you want to aim for these larger pip gains, then obviously you will be having the trade open for longer periods of time. And then, of course, there will be always news releases that will affect your trade in a bad or in a positive way. There's really nothing you can prevent uh, from happening, right? So yeah, it depends on the situation and depends on you. Okay, do we have any other questions coming in? Okay, Alatsun Bosson is also asking, okay, I just want to confirm about adjusting the stop loss to just to take profit. When should it be approximately done, and how many pips of profit per se? Okay, I'm trying to think of a scenario exactly what you are applying to. In general, what I can say about adjusting the stop loss is that if you are a shorter term trader, then do not adjust the stop loss based on what the market is doing. Just prior to entering the trade, determine your risk reward ratio, set the take profit and stop loss levels accordingly, enter the trade and leave the trade be. If you are a longer term trader, however, then it is only wise to indeed adjust your stop loss levels based on what the market is doing, just to lock in some gains, no matter what the market will do in the future. However, ultimately it will still be dependent on what are your goals, what is your risk reward ratio, what pippage gain you are aiming for. If you are in a longer term trade and you are aiming for 1,000 pip gain and the market has already moved, let's say 700 pips to your favor, there is upcoming news and you fear the price might drop 100 pips, for example, then it would be wise to perhaps move your stop loss 150 pips away from the current price, just to give enough headroom for this news to do what it does. If it does reach 100 pips in the other way, then you will still have the 50 pips of headroom for the price to find its place and find the direction. And it's possible that it will still continue in your predicted direction and hit that 1,000 pip profit target. Okay, but if the news will cause the price to fluctuate significantly, then you will have the stop loss in place just to lock in some of the gains of the trade. Okay, so it does depend on your profit targets and your risk appetite. Okay, I see a question from Lionel. Can you please make an example of the Kelly's risk formula? Now, I don't personally use that Kelly's risk formula, although some of our team members are highly recommending to use that. I would recommend to just replace the variables inside the formula with the variables that you generate. W is the win rate in percentage, and the R is the profit factor. Okay, the profit factor is the historical profits divided by historical losses. Okay, so just replace these variables inside the formula with the variables that you generate, and you will get a percentage. It's really straightforward. Okay, we are way past the hour mark. Again, sorry, this is something that does happen quite often. I do tend to over-explain sometimes when I get carried away. Anyways, I do hope that this webinar was informative to you, that you will be able to take away some information from it this time. Next week, we will be having a webinar on a brand new topic, and it's called What is a Strategy? And on that webinar, I will explain what a strategy is from my own personal perspective, what a strategy consists of, and perhaps give you a few suggestions what to keep in mind when you are developing your own strategy as well. Okay, so I will be looking forward to seeing you next week. It was my pleasure to host this webinar for you today. And please do trade safe and have a good rest of the day. Take care, everyone.